Joining us now, Paul McCulley is former chief economist at PIMCO. Paul, welcome. Jobs report was strong, tariffs bigger than expected. What's the scenario where the Fed cuts more than 3 times this year, given that? What has to weaken or improve?
What's the scenario? Obviously, 3 or more, particularly more, would be that we move into a recession, and then I don't know what the right number is. But I thought that was a great clip that you played from Chair Powell. And essentially what he told us is we've moved from a soft landing very quickly into a stagflationary purgatory. And it was really triggered everything by Wednesday and the tariffs, which are truly noxious in the standpoint they push the Fed away from both sides of its mandate. They don't know how much each way, but they know that it's more than they thought before Wednesday. So Mr. Powell was quite negative, I think, in being definitive about the fact that the stag is going to be worse and the inflation is going to be worse as well. But he was very agnostic of how this purgatory ends, in part because it's not his job to forecast that, but more important, he doesn't actually know. And therefore, he's going to sit there and let the information come in and tell us how nasty it is. And the bottom line is that he's not going to be preemptive. When we were in the soft landing era, you could think in terms of the Fed seeing nasty stuff on the horizon and trying to head it off. We're not in that world anymore. They're not going to be preemptive. They're going to want to see the data, and they will respond on the easing side if it looks like purgatory is going to morph into hell. But they don't know yet, and they're not going to do anything immediately.
Well, give me your wide-angle lens now, if you will. Paul, what country in the world, maybe what region, what market is the least likely to get damaged over the next 3 to 5 years? Where should investors look?
Wow. Obviously, something besides China, and I would tend to think more in terms of Europe, even though they're caught up in the overall tariff war. Because one big thing that happened before all this tariff stuff stopped is that Europe, led by Germany in reaction to their geopolitical issues, has declared that they're more willing to use fiscal policy than, quite frankly, I ever thought that Germany be willing to do. So when we think in terms of the trade war, it will tend to be with the developing countries, and that's going to be messy. But from the standpoint of a positive surprise going forward, is I think we could have a lot more homegrown growth in Europe as Europe effectively gets engaged with deficit-funded infrastructure and military spending. So I'm not table-pounding about this, but I lean more towards Europe as opposed to Asia, which has a mercantile history.
Paul, I'm going to ask what is maybe a very basic question here, but given the fact that the market, particularly the bond market, Fed funds futures market, with all the rate cuts that are now being priced in there, is pricing in a very real possibility of a recession here. Can you see a sustained spike in inflation with the implementation of these tariffs if consumption is falling and we do go into a recession? At some point, does that inflation come off because Americans just aren't buying stuff?
I'm with you 100%, Morgan, in that if you go into a recession, it is definitionally deflationary. The issue is deflationary from what level? So your tariffs effectively give you a one-time jump in the price level, which looks like nasty inflation as you're going up. But once you've absorbed the one-time hit, if you have a recession, in part because the one-time hit has eroded real purchasing power of consumers, then it doesn't stick and you actually get a disinflationary, deflationary bias on the other side. So you can actually paint a good scenario on the other side. but between here and there is truly noxious.